Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending March 31st, wrapping up the first quarter of Q1 as well of 2023. And we saw some pretty bullish price action for the week in the traditional markets, somewhat sideways price action for the cryptocurrency asset classes, but seeing a lot of bullish signals trigger this week as well. So I think it's a pretty strong chance that we'll start out April with some risk-on attitude and some opportunities to go long on some risk assets after we've seen kind of a bit of a cautionary period, as well as the bank issues that have been percolating. I still think there's some risk out there around the banking sector, but as long as we don't have any further banking collapses, then I think there'll be a pretty strong appetite for a risk-on move going into the month of April. Let's dive right into the charts here, taking a look at the cryptocurrency asset class. We're sitting at about 1.15 trillion on the total cryptocurrency asset class. And when we take a look at Ethereum, we're seeing similar price action, kind of chopping around sideways. We need to see Ethereum break up above about 1850 or so to hopefully look for that next leg higher. We do have an anchored VWAP to contend with at about 2016 on Ethereum, which is our previous all-time highs. And if we can get above that, then I think we'll be heading quite a bit higher for Ethereum. And then we jump over to the Bitcoin asset class. We're sitting at 28.5 or so right now. Some pretty sideways price action over the last couple of weeks. We have been getting up and testing this anchor VWAP, which is our previous all-time highs in Bitcoin, sitting at about 29,500 or so. We've tested that a couple times and failed off that level. So with Bitcoin specifically, I'm wondering if this is ultimately going to be a bit of a topping pattern and maybe see a brief correction here, or if this is just more of a bull flag before we ultimately head higher. If we do punch through that anchor VWAP level, then I think we'll be looking for an upside price target of about 35,000 for our next upside price target in Bitcoin. Jumping over the S&P 500. S&P 500 got above a couple of anchored VWAP levels to close the week out on Friday. Saw some really strong follow through there and ultimately closed above this 407, 408 level on the SPY. And then we still have one more key anchored VWAP to contend with, which is where we had peaked out at the end of January, early February. That's currently setting at about 416. If we see the S&P 500 get above 416, I think there's a really strong chance we'll see a pretty aggressive move to the upside on the S&P 500, and really even these other anchored VWAPs I think is a pretty solid trading level to contend with. As long as we're seeing price action above that 407 level on the SPY, then I think there's a reason to be optimistic for some strong follow through and some good bullish price action going into the month of April. Some of the things we're seeing really improve there when we look at the breadth measures on the S&P 500. We're seeing 60% of S&P 500 stocks are above their 200-day moving average, which is a massive improvement over the last few weeks. We were hanging out below the 50% level, which is a key kind of threshold level I watch. Below 50%, we have to start being a bit more cautious in the markets. We got right back above that level in pretty strong fashion to finish the week off with that 60% level. Also seeing a massive move in breadth of stocks getting back up above their 50-day moving average, now sitting at about 50%. We were just a week ago more down in this 25-30% range. And so definitely seeing a massive breadth improvement across the markets, which is great to see. And then we jump over to the NASDAQ on our triple Qs, also seeing some strong price action out of the NASDAQ. Big move off of this anchor VWAP level at 316. And that was our previous all-time highs on the triple Qs. So I think that's a pretty huge risk-on signal for the NASDAQ as long as we are above that 316 level on the triple Qs. I think we can definitely be playing this thing long. And I think that 316 level is a great kind of floor to trade off of as long as we're above that level on the NASDAQ. Definitely risk-on, in my opinion, for the tech sector and the NASDAQ. Take a look at our Dow Jones Industrial Averages. We just a few weeks ago were stuck below the 200-day moving average. We got back up above that this week. Also cleared another anchored VWAP level, which taking a look at that one, that was also the all-time highs for the Dow Jones Industrial Averages. So definitely a bullish development for the Dow Jones Industrial Averages as well. We can definitely trade off of that level at that 332. We're just right at that level right now, so hopefully we'll see some follow through on the Dow next week. But that 332 level is a pretty strong level to use as support for the Dow, and I think there's a pretty good chance we'll likely be heading higher there as well. And then we take a look at the transports. We saw some nice follow through there this week as well. Got back up above our 200-day moving average as we were below that, as well as below our anchored VWAP from the October lows of last year. And so we're below the 200-day and that anchored VWAP from our October lows. That was definitely a concerning, some concerning price action below those levels. But we've seen that recover, put in a pretty decent base, and it looks like we're heading higher with a real strong move out of the transports to finish off the week. And then take a look at our Russell 3000 chart. This is a great indication, I think, of also kind of discussing the breadth improvements that we've seen that we just discussed, and just seeing that Russell 3000 really push up strongly, not only getting back up above our 21-week EMA and SMA levels, which was a key area we were watching. We were really kind of in danger if we stayed below these levels for a few weeks of starting to see this SMA, EMA cross back over kind of in the negative territory. And so we really needed to see this Russell 3000 chart improve, and we definitely got that this week with a real strong move to the upside. Our RUA is sitting at about 2366 with just a big move up on the week, and things are looking pretty bullish and strong on our Russell 3000 right now. And then we jump over to our new highs, new lows list for the New York Stock Exchange. We can see some really nice improvement here as well. We are above our zero line, which is another key metric we watch closely. Below the zero line, we've got to start being much more cautious and defensive. We've been down below that level really for February and March for the most part, and so I was definitely playing the markets much more defensive while that was happening. But we're now starting to see that get back up above the zero line. We're seeing new lows really decreasing. We're not seeing any new highs in the new lows list, and we're starting to see the new highs list really start to accelerate to the upside. And then we're also seeing this 10-day moving average cross back up above our trend line here, and so all bullish looking indications out of our new highs and new lows for the market as well. Massive move at our large caps this week. So our weekly candlesticks here for the Russell 1000. Big move to the upside, got through our anchored VWAP previous all-time high, so large caps are looking really strong. They're continuing to outperform small caps right now, and I think we've got a pretty good opportunity to continue to see some follow through going into the month of April there as well. Small caps also are starting to do well after they were really kind of underperforming. A lot of the banking sector is in the small cap category, especially those regional banks that were struggling. So I think that kind of pulled down the performance on our small caps. We're starting to see that recover a bit with some decent follow through as well. So while large caps are still outperforming small caps, we're actually seeing both of them start to really recover off of the weakness that we were seeing over the last few weeks. And then when we take a look at our small caps versus our large caps on this chart here, we can see that we're kind of bottoming out at a pretty common level that we've tended to bottom out in the past. So we've right around this 0.78, 0.79 on this ratio chart has been a pretty common area for this relationship to kind of bottom out and then ultimately reverse, but we haven't seen that reversal quite yet. So we're still seeing large caps outperform small. And we'd like to, if we really want to get super bullish on small caps, we'd like to start seeing this head back up and to the right, which we haven't quite seen yet. But it's also not bleeding out like it was over the last probably about month or month and a half or so. And then we jump over to our growth versus value. Still seeing growth outperform value. However, this week it was a little bit more on the value side, just on the weekly chart. But still, I think the overall longer-term trend or mid-term trend on this is growth is still the place to be and is outperforming the value sector currently. And then when we take a look at consumer discretionaries versus consumer staples, this is a great risk-on, risk-off chart that I watch closely. Obviously, if consumer staples are starting to outperform consumer discretionary, that's typically a more defensive posturing, and so we've started seeing some weakness in this chart starting at the end of January, which is not a surprise because obviously we saw some weakness in the markets for February and a lot of March, and so we started to see this chart head down and to the right. But we ultimately put in a bottom here right at that 21-week EMA and starting to head higher from here, and so it looks like consumer discretionaries are starting to outperform staples in a pretty significant way, and looking like it is a risk-on atmosphere after all those banking scares that happened over the last few weeks. And then jumping over to the bond market, we can see TLT had a pretty strong day as well. We topped out right at that 200-day moving average, so we're not really right. I guess we're probably right at that 200-day moving average. It's hard to say if we're technically above or below it, but kind of right at those levels. We've got up here a couple of times on the TLT. So really what I'm looking for before I put in my next long trade on the TLT, I'll probably be expressing it with some call options once we can get a couple of days worth of price action closing and holding support at that 200-day moving average. We kind of haven't been able to do that, and when we zoom out on the TLT, we can see the price action's been stuck below the 200-day moving average going all the way back to January of 2022. So about five quarters now of price action essentially stuck below the 200-day moving average. So as soon as we can start to see price action get above that 200-day and hold that as support, then I think that's going to be a big trend reversal for the bond market, and we'll likely start to see bond prices head significantly higher. And while bonds typically don't move super fast, we had a pretty historic horrible year in bonds last year, so I think that's setting us up for a potentially historic great year in bonds going into this year, especially with the Fed likely going to pause on their interest rate hikes in the fairly short term, I believe. And so once that happens, I think that'll just pour more fuel on the fire, and we'll see bond markets really start to rip to the upside. So definitely looking for some bond trades in the near future, but we want to start seeing price action get above that 200-day and hold that 200-day. So we haven't quite got there just yet, but I think we're getting pretty close. And then we look at IEF on the bottom panel here. We have spent a little bit more time above the 200-day, but we've also just fell back below it, and the last couple of trading days we got back up above it. So need to see a little bit more price action hold that 200-day on the 7 to 10 year bond as well. But I think pretty much across all time series we're going to start to see these bond plays really start to outperform in the coming weeks and months. And then jumping over to our sectors that we track, we can see at the top, really across this whole list here, just about everything in the green on the week. A very strong week for risk-on assets. At the top of the leaderboard, we saw cloud computing up over 7%, and some of our ARC funds, ARC FinTech as well as ARC Innovation, up about 7% as well. Just about everything in the green on the week, though. So if you're in just about any asset class, you hopefully made a little money this week. The only sectors that were down on the week a little bit, gold was slightly down 0.2%. The TLT 20-year bond was down 0.4%, and still seeing natural gas in the bottom of this list, as it's tended to be there for quite some time now. Natural gas down about 5% as well. Then when we jump over to the global markets minus the United States, we're starting to see global markets rebound as well. We've been seeing China starting to look like it's got showing some signs of life there, and I think we're just starting to see potential rebound in the global markets as well. As long as we're seeing that VEU stay above that 52.22 level, I think that's a pretty strong area of support, which is just above our 50-week moving average rather. And things are starting to look interesting on global markets as well. And then we jump over to our crude oil prices. We bottomed out at the 200-week moving average, which was kind of an area we've been talking about for some time, as we were kind of chopping around up here looking for that 200-week moving average as a potential support. Figured if we dropped a little bit lower, maybe we could go as low as 60, but it looks like that's probably not going to be in the cards. We held that 200-week moving average really nicely over a couple of weeks, bottomed out at that level, and then saw a real strong fall through to the upside this week, back up to about $75 a barrel or a little bit higher than that. So it's looking to me like I think there could be some energy trade setups materializing as well. And we'll get into that a little bit later. I think we'll finish off this video with actually a energy trade that I'm already in. And as long as oil doesn't drop down back to that 200-week moving average or fall below it, I think we're going to likely see oil prices head higher from here, and could be setting us up for the next leg up for the energy trade as well. And then taking a look at the CRB index. CRB index kind of broke down off of these levels that we were stuck at between about 265 and about 285 or so on the CRB index, and chopped around there for quite some time. Ultimately broke down, so we were kind of thinking maybe we could potentially see some pretty significant drop out of the CRB index, but ultimately, while there was a bit of a decline down to about 255, the last couple weeks we reversed that, and we're now back up into this kind of sideways range that we were stuck in right at about 267 to close the week out. So does not look like the commodity index is going to be necessarily collapsing from here, or it's possibly just maybe a retest before we do roll over and head lower. So we'll keep a close eye on that in the coming weeks. But it looks like any idea of the commodity index really collapsing doesn't look like that's going to occur, at least in the short term. And then jumping over to our precious metals, gold and silver has been pretty much some of the biggest trades I put on for the month of March, as I was playing it much more defensive with the banking issues and some of the signals we were getting. And precious metals were a great trade in the month of March. Question is now, are we going to stall out here and potentially correct a little bit, or is this just a bit of a pause before we ultimately head higher? We are going to jump into the rate charts here shortly, and it looks like rates are rolling over, so I'm tending to hang on to my precious metals trades for now, especially if rates continue to roll over. That's typically a strong sign that precious metals are heading higher. And so I'm hanging on to the precious metal trades for now, but if we see a significant breakdown in the precious metal price action levels, then I'll probably take profits on those trades and just look for the next buying opportunity. But also, because rates are continuing to head lower, I want to hang on to these trades just in case we get another breakout and ultimately see precious metals head even higher from here. When we take a look at the gold futures, we're sitting at about 1986 to close the week out, and it looks like we're putting in a little bit of a bull flag. Another reason I'm kind of hanging on to the metals trade, even though we have seen a little bit of a stall out recently. I think this is ultimately putting in what looks like it could be a bullish flag for the gold futures, and that would suggest that we'll likely break out after a period of a pause and then ultimately be heading higher from here. So hanging on to those metals trades as well. Interesting chart I looked at this week. This is actually the GLD divided by the SPY. So this is a relationship chart with gold compared to the S&P 500. And as we can see here, this is going back quite some time. This is the gold was actually outperforming the S&P 500 for a period of time from about 2005 to about 2011, and then from 2011 till pretty much current. We've seen essentially a massive underperformance out of gold compared to the S&P 500. Now, we've definitely seen a few little blips where we've seen little surges out of gold. We obviously saw one in 2020 when we had the COVID crash. But by and large, the more longer-term trend has been the S&P 500 significantly outperforming gold. However, we've now come up against this trend line here for the third time just recently, and I think there's actually a pretty good chance that we're going to probably break out of that. And so that's a chart I'm starting to watch really closely, because if we do see gold break out above this trend line here, I think that'll likely be a signal that we're going to see some significant outperformance out of gold going forward. And we're already starting to see some strong signs out of the precious metals sector, but I think what this chart's telling us is we're just getting warmed up, and we're in the early innings of what's likely going to be a much longer bull market for precious metals. So definitely watching these asset classes closely for 2023, as I think there's going to be a lot of trade setups in this space, including the one we're currently in right now. And then taking a look at the silver chart, the SLV. This is also at a key level right now, so we can see that we've had this pretty strong trend line going all the way back to 2021, and we've touched this level a few times, and each time that was essentially a great time to sell gold, because it ultimately corrected pretty hard from there. I think this time might be different, and so again, I'm hanging on to my precious metals trades for now. However, if I do see going into next week silver really roll over from here, I'll likely take some profits and wait for the next buying opportunity, but still holding out hope that we might see that push through finally on this level. And if we do, then I think there'll be a really strong chance that we'll start to see a pretty big move up out of silver, and we could easily be looking for this $27 or $28 price level on the SLV. When we take a look at the silver futures, those have just been really moving up and to the right as well. We're kind of back up to these levels where the silver futures are at back in December, January. So to see some follow through on silver, we'd obviously like to see those silver futures get back up above 24.50 or so for kind of some confirmation that we're likely heading up into the next leg higher for silver. And then jumping over to our interest rates, pretty much across all the time series, we're seeing interest rates at least flattening, if not coming down. So the 3-month has been fairly flat on the week. A couple of attempts to kind of break back up above this 4.81 level. Ultimately, it's failed each time, and we closed the week out lower at about 4.66% on the 3-month. When we take a look at our 2-year, we are now sitting at the 200-day moving average at just above 4% on our 2-year, but it looks like we're probably heading lower from here there. And then when we take a look at our 10-year, we are actually below our 200-day moving average as well, and below that 3.5% level. And it looks to me like the 10-year rates are likely rolling over from here, and as long as that continues, I think that's what's ultimately going to continue to set up some bullish price action for the precious metals. And when we take a look at the 30-year, also seeing some rollover here. We did get up and retest the upper bounds of this trend line just recently this week and rolled over pretty significantly. So I think just about whatever time series you're looking at on interest rates, I think the trend, at least in the short term, is lower for rates, and really probably even for the longer term rates, because I think we're getting pretty close to the Fed rate hike cycle being over with. And so at a minimum, I think we'll have anywhere from sideways to downward pressure on rates going forward. And then take a look at our euro-dollar futures chart. Looks like the Fed funds rates is implied at about 5.25% currently. So somewhere between about 5 to 5.25 seems to be where the market's pricing in where the Fed funds rate will likely end up. And I think we're currently at 4.75 to 5. So another reason why I think we're very close to the end of the rate hiking cycle. We might get one, maybe two more rate hike cycles, and I think that will likely be a pause out of the Fed from there, and that'll likely signify a big move out of bonds once that does happen. And then jumping over the dollar index, the Dixie, while we did see a little bit of a move up on the dollar on Friday, ultimately the longer term trend is still to the downside, and still expecting the dollar to head lower from here. Take a look at the high yield corporate bond ETF. This is another chart that I watch closely for kind of market health indication. So we can see in 2022, as the HYG dropped, the stock market followed. And then as we started to kind of bottom out on HYG around October, that was right around the S&P 500 lows. And then when we started to see HYG recover, that ultimately was the stock market recovering as well. And so HYG is a great kind of indication as to where the markets are likely headed from here. If the HYG is getting beat up, it's typically not a great sign for the markets. And we saw some massive follow through to the upside this week on our HYG, getting back up above the $75 level, which is a pretty key area of support and resistance in the recent past. And we are also above our 50-week moving average, which looks pretty great as well. So things are looking pretty good, and risk on signals out of the HYG currently. And then jumping over to our LQD IEF chart. So this is another chart that I look at for overall market health. This was definitely one of the most interesting charts for me over the last few weeks or months that I've been watching really closely, as we did get that crossover for a bullish signal back in, actually it was in November, December of last year. And then now we ultimately came back down and saw price action drop below these key EMA and SMA levels, which are at 13 weeks. So it basically represents 1 quarter of price action. And anytime we see the EMA cross down below the SMA, that's a risk off sign. And so at one point after that banking crisis occurred, we were really starting to see this start to invert, and it looked like we were potentially even going to cross. And if that happened, that would have been a pretty bearish indicator for the markets. But ultimately, while it did come down and get pretty close, if we zoom in here, we can actually see that not only did it kind of bottom out, but now just a little bit on Friday, it's actually starting to trend back up to the upside. And so when we zoom out on this chart, we can actually see that almost each time after having some significant time in a bearish signal with this chart, we oftentimes break out and then come back down and kind of retest these levels and kind of get dangerously close to a cross, but then ultimately that cross doesn't happen, and that sets us up for the next kind of bull run in the markets. And that's looks like that's what's occurring right now, and so that is looking like a risk on signal to me. And as long as this trend continues and we don't see that EMA crossover, then I think that is potentially a very strong bullish signal that we might actually see some surprisingly bullish price action. I think a lot of people are still being very defensive and concerned about the markets, but I'm thinking based on what we're seeing this week, and as long as this we get follow through on these charts in the following weeks, things are starting to look pretty positive in my view. And then when we jump over to put call ratio, we're below 1. I'm kind of surprised it's actually this high based on the price action this week, but we are below the 1 level, which is typically in kind of a normalized range. Anything between 0.5 and 1 is kind of a normal balance in the market. Anything above 1 is typically negative territory, and people are buying extra protection in the markets. So that probably, again, I think just comes down to the fact that we've obviously had some pretty big freakouts over the last few weeks with some of the banking issues, and so people are still being a little bit more on the cautious side. But I think we'll likely see these numbers head lower from here if we continue to see this bullish price action continue going into the next few weeks. And then jump over to the VIX. We can see the VIX is now back below 20. Obviously saw some pretty significant spikes in the VIX over the last few weeks. Got above 25 and even had one day where we got back up above 30 briefly. Didn't actually close the day out at 30, but there was definitely a huge spike in the markets and fear, justifiably so, with the banking issues. But since the Fed stepped in and kind of backstopped those deposits, that ultimately kind of put I think, insurance policy in on the markets and essentially saved us from what could have been a sell-off in the markets and likely supporting a risk-on rally that I think is just about getting going here. So VIX closed the week out at about 18.5, so things are looking pretty good there. So we'll go ahead and close out the week on a trade opportunity, as I think there are quite a few in the markets right now to take advantage of. I like this one a lot, though. This is Gush, which is a 2x ETF for the oil and gas sector. And as we talked about earlier, the oil prices look to be putting a floor in at that 200-week moving average, and we're starting to see some positive developments out of both the XLE and the XOP. But I like trying to find alpha in the markets, and these levered ETFs, as long as you're on the right side of those bets, can be a great way to deliver some upside. And when we take a look at this chart, this is going all the way back to essentially the COVID lows, and we've got a very defined channel here in this levered ETF, and so that basically tracks the price action of the oil and gas explorers and producers. And so we've now touched the bottom of this channel 3 times, which we just hit in the last week or so. And then we can see we've had many touches at the top end of this range. And so essentially on a longer term time scale over a couple of years, we are at an extremely affordable area to buy this, in my opinion. And as long as this trend line holds support, which it has so far, we actually did a little double bottom off that trend line and then started heading higher. And that's when I got into this trade, looking like some serious upside opportunities in the space. If we see a rally in oil, instead of trying to pick stocks and figure out the winners and losers, this looks like an excellent trade setup opportunity. I got in this one right around 115, 116. It's at about 123 already, so already up a little bit on this one. But looks like just a massive upside opportunity in this. If we get a big rally out of oil, we could absolutely get back up to the top end of that trend line, and that would represent anywhere from about 250 to 300% upside. Probably over a period of time. It's not going to happen overnight, but I think there's a pretty realistic chance to expect that we could potentially get back up to the upper bounds of this trend line. And either way, whether we get all the way up there or not, we are definitely at a pretty nice discounted price level that's ultimately been held and respected there a couple of times now. So I really like this trade setup, and looks like a pretty good risk to reward setup for some really nice upside, especially if we see oil prices stay intact and continue to see the XOP and XLE start to rebound off of their otherwise fairly weak performance in the first quarter. But I think that's likely going to end, and we'll very likely see some outperformance out of the energy sector for a pretty good stretch of this year, if not maybe potentially the rest of 2023. But the only thing I think that would take down the energy sector from here would likely just be a big collapse in the markets. If we see a big recession coming, then I think oil prices will kind of slow down, if not correct as well. But for now, I think we've got a risk-on environment, and with that risk-on environment, I think energy is going to continue to outperform, and this Gush trade setup is a great one in my opinion. So check it out. Ticker GUSH for some big upside alpha in the energy space. So thanks for tuning in this week. Make sure to download the ToroAlerts app on the App Store. We got one for stocks and one for crypto. And you can also check us out at ToroAlerts.com.